My discussion here is what we've seen is a lot of exploration joint venture deals over the last 12 to 18 months. And so basically we'll talk about what brought this on and how we would actually value a deal when we see it in the junior space. Okay, so basically it's how did we get here? How are the majors coping? These are the people that are actually doing the deals. What's their attraction to somebody's play? And so what does a deal look like? So how did we get here? So this is focused in on the gold space because it's really a lot easier to dissect. And we'll talk about the reserve grade drops. We'll talk about grassroots exploration. And we'll talk about low cash generation. So what we've seen is that with the rise in the gold price, we've seen a massive move in reserves. So, you know, we were sitting at 300-ish, 350 million ounces of reserves, and then we hit 650 million ounces of reserves in 2011. All driven, as you'll see, by the gold price increase at about 85 to 90%. But as the gold price fell about 40% or $600 per ounce, we saw another drop, a 200 million ounce drop to 400. So here's a real question in terms of investing in leverage. So if you invest in a leverage play in gold space, really that's what you're betting on, because there's 200 million ounces out there of leverage that's just been taken off the market that are in the hands of majors that they could put on in a second without a transaction, without any kind of due diligence. So just note that. And so here's what we've added. We've added a lot of less than economic ounces. So we've had a 50% decline in the grade. And so that's the grade that they've been writing off. And right now, over the last 3 years, it's basically stabilized because they haven't actually added anything of quality. And so what's behind that is, okay, we've had, you know, the peak of exploration. So on an absolute basis, you know, the exploration has been higher, obviously in 2011, 2012. But I'm concerned about the green bars because, you know, the issue has been the drop in grade. So is brownfield exploration, late stage exploration, is that going to actually generate that kind of high margin deposit? And what we've seen is that there's been this secular trend here that we're really concerned about, or want to note, since about 2003, 2004, where the proportion of grassroots exploration has been declining. So that's been happening even before 2011, 2012. And so if we take an example like Barrack, if we look at the proportion of their revenue, gross revenue, sales revenue, for what they spend on G&A and for what they spend on exploration. So I've taken that back to 1997. And kudos to Barrack, they had everything on their website to take. And so you can see the G&A secular decline, which was good for Barrack, between 4% to below 2% to almost 1% until Chairman Thornton came on. And then it went back up to about 3.5%. And now it's sitting at about 3%. But look at exploration, grassroots exploration, their exploration. At one point, on a relative basis, it was 8% of their sales revenue. So if you think about it, it goes, okay, I make money, and how much am I willing to reinvest to keep making money? And it seems to me that that initiative to reinvest has become declining. It's declined a lot. But whereas G&A is now flattening at 3%, their exploration has been trending down. And so right now, encouragingly for Barrack investors, it's popped back up to the 4% range. But what has that gotten them? So with that secular decline in exploration expenditures, with the lower gold prices, their new business plan has been, for the last few years, about a core of assets that works in a low gold price at $1,100, when sometimes their business plan is $1,000 gold. But what does that get you? That basically allows you to have a low all-in sustaining cost, but a flat production profile. But the market's okay with that because now it's not the growth of ounces, which historically it was when I worked for a major. It's now the growth in free cash flow. Again, that could change as investors' tastes change, but right now it is about free cash flow. And you can only generate strong free cash flow, strong positive free cash flow from quality assets, which probably 60 to 70% of their asset base represents. And so then you think, well, do these guys make any money? So if we go back 5 years, and I just looked at net cash flow, not free cash flow in this instance, because a lot of people had to pay debt because of a lot of write-downs. But out of these, seven companies with a market cap of about $75 to $80 billion between all of them, and 350 million ounces of reserves, they were able to generate on average $35 million per year of net cash flow. That's it. So how are they coping with this lack of growth, the need for quality? So you can see like presentations now from Newmont Mining where they actually look at their approach to their long-term strategy. And what stands out to me is this acquisition of now early stage projects. They're more keen on the early stage projects. They're cheaper. There's more probability they'll get something high margin. And also investing in prospective exploration joint ventures. Why? Because they don't have an exploration budget anymore. They don't have a lot of these people that are on the ground, and what they're missing a lot is the eyes and ears on the ground. It just doesn't exist. And so now they're taking part in conferences. They're going to the institutional investing conferences. They're going to equity conferences, retail conferences. And this is from the Precious Metals Summit. So you see one of the big increases year on year in terms of attendees has been corporate development. And so you can see companies getting a lot of meetings between institutional investors, but a lot has been from major companies looking for new projects. And so there might be 2 people on their side in terms of the junior, and there might be 10 people on the other side in terms of the major. And so what have we seen on the financing side? So this is the financing on the TSX, the main board, which has declined 16%, but on an absolute basis, a lot more money is obviously raised with those companies because they're a much higher market cap. But on the junior side, on the TSX venture, there's been a 50% increase. But a lot of that increase on the venture has been major gold producers basically investing in juniors. And so we looked at, in our own numbers, a bunch of companies. Let's see, this is 10 companies that have organized 32 deals between joint ventures, earn-ins, private placements that are worth, not that they've spent all this money yet, some of these are staged earn-ins, committed about $1.2 billion, and mostly in gold, copper, and zinc. And so what's the difference that we've seen is some of these guys are active, some of these guys are passive investors. And this recent investment of Newcrest, which is a major gold and copper producer in the Australia Pacific area, with their investment in Lundin Gold recently, they've shot up in terms of being #1 on our list in terms of investing in these juniors. Why? Because, I mean, they have a big reserve base, but they seem to be isolated in Asia Pacific, and now with geopolitical risk or their demand for geographic diversification, they're playing the Americas big. And so they want to find assets right now. And they've been quite good at turning around deals. And so everybody else in the North American market now have to compete with them. And so what's the difference between passive versus active? I mean, the passive guys will give you some sort of technical support, but the programs tend to be handled by the junior. It's only an equity investment, don't joint venture, no earn-in. So some examples is January 2017, Gold Corp did a $35 million placement with Orin Resources at a 50% premium with no warrants. I mean, juniors love this. You get a premium, no warrants, don't have to pay a broker. It's great. And Kinross, same thing with Orion Gold. I'm not sure if everybody's doing it with companies that start with A, or if that's what the first thing on their list was. But the discount, this was at a discount with no warrants. But from what I understand, they had a big run up in the stock while they were discussing it. And so this was still at a good price for the junior. Well, the active ones, they will provide technical support. They want to eventually transition to be an operator. So examples would be March 2017. And interesting, that's March 2017 and April 2017, and both these assets are in the Yukon, and both of these are the two biggest gold producers in the world. So Goldstrike forms a strategic alliance with Newmont Mining to advance Plateau Project, a multi-stage earn-in, 75%, 49 million, let's say, of potentially committed money. I mean, stage, but they offered a 94% premium. And I remember asking the Newmont guys about that. Because I used to work for them. They just said, oh, talk to business development. That's not our deal. But the thing is that they don't really care. It's not a lot of money for them. And if it makes the transaction go faster, here's a couple million. I don't really care. And so that's the advantage the junior can take in terms of the market or the company's ignorance as to what that means to them. April 2017, the same sort of thing, Barrack with ATAC. And here's something to note is that ATAC had a passive investment by Agnico 4 or 5 years ago. That passive investment gave them an initial jump in the stock, but after that did nothing. Because really what ATAC was selling was, hey, we've got this Carlin thing in the Yukon. We've got potentially 3 Carlin belts in there. But having Agnico, who don't have anything in the Carlin trend, didn't really give them that stamp of approval that they wanted. But having Barrack come in and doing a joint venture and a big earn-in, which is, could be up to $55 million, did give them that stamp of approval. And as you'll see, that's one thing the juniors want as well. So what's the attraction? Okay, so the Barrack's Carlin play in the Yukon that I put on, phased, multi-year, so there's risk, but at any stage I can bail. So stage 1, maybe 60%, 35 million to 2021, gives me a lot of time to figure this out, and then I can bail. 80%, another 20 million in 2026. But, by that time when I get to 60, I know a lot more about the project. Large landscape, district scale land package is what I want. Any major company, that's what they would want. And they're not so concerned about the infrastructure in the Yukon right now, because right now they're thinking a 10-year play. They're not thinking tomorrow. I don't need the infrastructure tomorrow. Let's find something right now. Let's find 10 million ounces. And let's see how that goes from there. And then what they get to bring to the party is their leverage to the Carlin type. So the only two people that could give that significant leverage to expertise would be Newmont and Barrack. Okay, so let's make a deal. Let's see what a deal looks like. So the first thing for a junior to do is match the project with the JV partner, right size, right fit. But like I said, with the Carlin thing, if I want a stamp of approval about Carlin-type deposits, get me a company that knows Carlin. Then the market will realize that that's a good stamp of approval. The bigger, the better. And so Rackla is a huge land package, So it's better to have 20 to 30% of something significant than 100% of nothing. Equity placements, again, get them with no warrants and get them at the premium because, again, they don't care. They're not in it for the equity. They're in it to find that high margin deposit. That's really where the value is for them. Cash payments. So try to get a few cash payments to sustain a bit of your G&A. Don't take it all in cash because, personally, we don't like it when all of it just goes into cash and doesn't go in the ground. Operatorship. Juniors should own the operatorship at least for the option or the initial phase of earn-in until it goes to the big money spend. And I can tell you that a lot of majors will cede that if you've got a good technical team. That's what they want because they don't know the project. They don't know how to work there. And to bring their people in, sometimes it costs them $1.50 for every buck that you spend. And again, technical support, leverage expertise. But this is leveraging expertise on both sides because some of these juniors have a lot more experience in exploration right now than the majors do because of all the cuts that they've had to do with grassroots. So then you get the chess match between the two parties. Again, staged earn-in, minimum expenditures. The opening should be a well-defined expenditure program, like I want X amount of drilling. I want you to work this area. I need this. That's what you want. So if they do leave, you get that. You get that add-on value. The middle game is to incentivize them to keep working. Don't let it sit. You want them to go big or go home, but you want them to do it quickly. I mean, I'm saying quickly, I mean 3 to 5 years. I'm not saying 20 to 50. You don't want them to sit on projects. The end game, funding to production or dilute to a royalty. No buyback. Avoid that like the plague. So news flow. So you want news flow. So you don't want the major to control the news flow. You want them to basically, you want to own it. So if it's drilling, you want to be on that drill rig. If it's analysis on the assays, you want to own it. You want the geophysical results. You want everything that's going to look so the market can see what's happening with the project. They don't want to see it in the major's hands, and then you'll get a report on it 3 weeks after they put out their quarterly. And the fallback, again, if they don't like it and they want to move on, that's fine, because some projects are just not big enough for a major, but it might be big enough for somebody else. So you want a fallback that they slowly cede control or even revert to a royalty and then they're gone. So then you can offer it to somebody else. And so here's an example. So this was done recently with that same company that we were talking about, Newcrest Mining. So this was Mirasol Resources, a company we own in terms of a prospect generator. And so we'll focus on the initial phase. There's no deliverable. But what they wanted was a minimum expenditure, a commitment. Mirasol ends up the operator. They control the news flow. They get a management fee to operate, and they get a cash payment. So it's exactly what you want. And then to get to the next stage, stage 1, then you have a bigger spend, $8 million. Now we're talking a bigger term, 4 years, but you're also talking a bigger cash payment, $400,000. At this point, they can decide whether they want to operate or not, but they got to give Mirasol a 6-month notice. Then you're moving on. Now you've got your majority. You got 51%. Now you want to go to 65. But now, you know what? I want deliverables. I want the resource. The time frame is 2 years, but now you're making your last payment. So now I'm less concerned about payments. I'll get this one because I want my payments up front. But now I need catalysts. I need deliverables. I need big-time deliverables. But when you start drilling a resource, that's a lot of money. I don't want to be controlling that. You guys do it. But I need that deliverable. I need the results, and I need to issue the 43101. And you got to give me this. And then it becomes this blowout stage of the bankable feasibility study. But what Mirasol did at that point, okay, there's no more cash payments. Now it's all about that deliverable. You've got the resource. You're trying to de-risk it. That takes time. But if you don't do the bankable feasibility study, your option is to spend about $100 million in the project. So that's huge. So you're more incentivized to do a bankable feasibility study. But if you decide that this is not a 1 million ounce deposit, but a 5 to 10 million ounce deposit, you might want to keep drilling. But look at also at what's happening with the adding time to any stage. So if you decide at stage 2, well, you know what, I need more than 2 years. Okay, great, but pay me $250,000. At stage 3, I need more than 1 year. Okay, pay me $500,000. You need 2 years? Okay, pay me $750,000. So that way the company can keep going, and that sort of pays for the lack of the news flow around that time so they don't have to raise money. And so this is what we talk about as the initial payments for the delay. And Newcrest obviously has the option to exit after the initial earn-in with no earn-in. They got zero. They spent the $1.8 million. They paid Mirasol. They didn't like the project. You've got zero. So I can relook at the project, use that data, and try to farm it to somebody else. But if you exit stage 1 or 2, I'm diluting you. So if you've got the 51, you go down to 49. And if you got the 65, you go down to 60. So you want some of that in there. So in summary, higher gold prices leading to adding reserves with low grades. And so now we've got low cash flow generation. We've had a secular decline in grassroots exploration. So we're there. And so we say, well, gold price is still about flat, $1,300, $1,350, but I've got even lower reserve prices. I need projects that work in that kind of environment. I've got no way of finding them. So what do? I'm going to go to the earn-in stage with juniors that I trust, that have technical expertise in the jurisdictions that they're working in, and with the style of deposit that they're working in. So it's not only that if you look at a technical team, oh, this guy's great at, stratiform copper, and then goes, well, this is a porphyry. Does he know anything about that? And so you got to match that as well when you're looking for technical expertise, because definitely the company will. And so these joint venture projects held by juniors will help boost their own pipelines, and that's what they're looking for. Okay, again, big land package, large deposit analogs, good jurisdictions, long-term plays. That's what they're looking for. So from the junior perspective, this trend that we're seeing right now, especially with a flat gold price, will benefit top-tier prospect generators and grassroots exploration companies, which, like I said, right now have a lot more grassroots exploration expertise than some of the majors. So again, operating mining-friendly jurisdictions, competent technical teams, those are the things you want. They've got the highest probability of success. Juniors, as an investor, what they're seeking is endorsement, a bit of cash to pay for all their trouble, expertise, both sides, and that helps with the endorsement. The deliverables, so I could take that to the market, fallback. So if you don't like the project, I can keep majority and farm it out to somebody else, or you could dilute to a royalty. The other thing is that if I get to 80% or you get to 80%, I'm left with 20%. I don't get hit in the markets by because they think I've got to raise 20% of $500 million, because I can also take the dilution clause where I end up with a 2 or 3% NSR. So that's another thing you want to look at. Okay, that's us, Exploration Insights, and we'll move on to the next talk. Thank you.